No other era is even close to what we're doing right now. I think a lot of these bubbles, as they deflate, the money is ultimately going to go into consumer prices.
To stop using the word monetary stimulus, there is no monetary stimulus. There is money printing. Yes, there is money printing and debt monetization, but it has no stimulative effect. All right, now you're way over the line because
you're saying inflation is prices going up.
You're putting words in my mouth that I never said. I said that.
I would not put any stock into what any Fed chairman says, because you always have to remember that these guys are there to tell a story, and they always want to put a positive spin on everything. Like when Ben Bernanke was at the Fed telling everybody not to worry about the mortgage market, subprime was contained. He later admitted in an interview after he was no longer Fed chair that he didn't really believe that. He was just simply trying to advance the administration's view that everything was great. And so he couldn't really speak his mind. He kind of had to act as if he was part of the Bush administration. In order to validate their easy money policy, Powell basically has to say that any increases that we experience in consumer prices are just a temporary aberration. It's transitory. Don't worry about it. So I think we're understating the increase in consumer prices. Plus, a lot of the liquidity, the inflation that the Fed was creating, it went into the stock market. It went into the real estate market, into the cryptocurrency market, into the bond market. I think a lot of these bubbles, as they deflate, the money is ultimately going to go into consumer prices, commodities, and things like that. And so we're about to see a tsunami of inflation. And whether the Fed is oblivious to it or just lying about it, there's no way to know. And I think it's already started. I mean, you could look at some of these price increases, and they're very spectacular. And again, I don't think we're transitioning, or it's transitory, unless you're saying we're transitioning from low inflation to high inflation, which is what's happening. But what you want to look at to understand inflation is you look at the money supply, because it's the money supply that was being inflated. I mean, literally, that's where the word comes from. Inflation is to expand. You inflate, right? When something is inflated, it expands. Prices don't expand. They go up, they go down, but they don't expand. It's money supply that expands. And we have the most expansionary monetary policy in U.S. history. And no other era is even close to what we're doing right now. So this is massive inflation. And so to expect that prices are not going to respond by rising is ridiculous. A lot of this money that people have saved was sent to them by the government. And yes, a lot of people haven't been able to spend it yet because they haven't got out of the house. They have bought a lot of goods. Unemployed Americans have been able to shop on Amazon, but there's still a lot of other money that they haven't spent yet. Eventually, all of this hoarded cash is going to be spent. And if we're not producing more goods and services for the money to be spent on, then all it could do is bid up the prices on the goods and services that already exist. Janet Yellen was asked a question today. The question was, why aren't you worried anymore about the debt? Her answer to that question was that, well, interest rates are really low. And the reason it's not a problem is because the rates are so low. And so servicing the debt is not that big a burden given how low rates are. Well, if you have this huge amount of debt, and the only reason there's not a crisis is because interest rates are low, what happens if they're not low? What happens if interest rates are high? The only thing between the U.S. government and default is artificially low interest rates. So if the Federal Reserve knows if it raises interest rates, it bankrupts the government, how is the Federal Reserve going to fight inflation? The answer is it can't. My thinking is if it can't fight inflation without bankrupting the U.S. government, it won't fight the inflation, which means it bankrupts the U.S. public because it destroys the value of the dollar. Well, first of all, before the dollar was the reserve currency, all those other currencies were backed by gold. I mean, they weren't just fiat. I mean, the dollar is the first currency in history to achieve that status as pure fiat currency. When the dollar originally became the world's reserve currency, it was backed by gold. In fact, it was redeemable in gold on demand. I think that when the dollar is no longer the main reserve for all those fiat currencies, they're not just going to pick another fiat currency to replace the dollar. It wouldn't make any sense to just go to the euro or to go to the yen. because at the end of the day, they're just paper too. I think the dollar's demise is going to introduce the remonetization of gold. Not that it was ever demonetized by central banks, because central banks all hold gold. But I think gold is going to replace the dollar as the primary reserve asset for all central banks. Right now, all they have to do is print money. So if the government wants something, they just need to print money and they can get it. But in the new world where gold is the reserve, if they want something, they need the gold to pay for it, right? They either have to tax the citizens or they're going to have to, start dipping into their reserves. So the U.S. gold reserve can be depleted very quickly if we need that gold to pay for things. See, right now, we don't need anything to pay for anything. America is the biggest beneficiary of this dollar standard, because let's say you take a small country. Let's say you take New Zealand. If New Zealand wants to import, it has to export. The New Zealand dollar isn't the reserve currency, so it has to earn dollars in order to buy things that are dollar denominated. We don't have to earn anything. We just print them. It only makes a difference to the United States, because now we go from printing something to earning something, and it's a lot harder to earn than to print. When governments are desperate, they do desperate things. You can look at other countries when capital starts to flee because there's a lot of inflation or high taxes. Governments try to plug up the holes so they can keep their victims stuck, and they can keep on, victimizing them with taxation or inflation or whatever it is. So it certainly is possible if things really start to get bad. But right now, not that many people understand this threat. I mean, they're just oblivious. They believe the Fed, just like they believed them in the past. So right now, only a small number of people are buying gold and buying real assets and getting out of dollars. So right now, there's no taxes, which is another reason to do it now, because they can't impose the taxes retroactively. So, that would be illegal. So if you already have your money out of the dollar and then they impose those taxes on getting out of the dollar, well, you're already out. So you're not going to have to pay it. So don't wait until they're trying to, put a toll road there. Right now it's a freeway. You could get out. There's no toll. But at some point when a lot of people want out, there's a good chance that there will be a toll.
You say, what's the secret behind I think it's garbage, by the way, but you say, what's the secret behind it? Well, the secret behind it is if you can issue debt and collect taxes in the money that you print, you can force people to accept the money because they need the money to pay their taxes. And if they don't pay the taxes, they end up in jail. And the point is, it relies on state power. It's really a neo-fascist concept. It relies on coercion, the point of a gun, jails, and state power to enforce the confidence in money. Now and they say that. The Fed is trying to get out of this. They're trying to normalize the balance sheet, trying to normalize interest rates. So they had to get rates up, balance sheet down. Why? So they could prepare for the next recession. How do you cut interest rates 4% if you're at 1? Well, the answer is you can't. And that's why they came up with quantitative easing. So the effort was get to 4% rates, $2 trillion balance sheet, and you're ready for the next recession. They will not be able to prepare for the next recession without causing the recession that they're trying to prepare for. And that's exactly what happened in the fourth quarter of 2018. The stock market dropped 19%. And that's when Jay Powell threw in the towel. He got religion. He said, okay, first he said, we're not going to raise rates anymore. Then he said, we're actually going to cut rates. And then in September 2019, they started QE4. That was before the recession, before the depression, before the pandemic. They were already in QE4 and cutting rates again. So they can't get out of it. So they prove that the failures manifest. They prove that they can't get out of it. And what can they do? Yeah, well, first of all, I encourage everyone to stop using the word monetary stimulus. There is no monetary stimulus. There is money printing. Yes, there is money printing and debt monetization, but it has no stimulative effect. You don't get inflation from printing money. You get it from velocity, which is psychological, which the Fed doesn't understand. But the biggest threat is deflation.
Well, first of all, the only thing you're going to see deflation measured in is gold. But in terms of fiat currency, prices are going to go up dramatically because they will continue to print the dollar until it no longer has value. That's the only thing that's going to stop it. What we've seen so far, even with the civil unrest and the riots and the looting, this is just a small dress rehearsal for what's coming. Because when the dollar crashes and prices skyrocket, these stimulus checks or whatever welfare benefits the government wants to dispense, they're not going to be worth very much. I mean, because you're not going to be able to buy anything. And I think the government is going to respond to the surge in consumer prices with price controls. I think there's going to be controls on all sorts of consumer goods, and that means shortages. That means long lines. I think you're going to see a real blow up, particularly in the cities. There's going to be a lot of crime, a lot of violence associated with widespread shortages and a lack of food and power outages. So things are going to get pretty bad as we go through a monetary crisis. It's not, this is not just a financial crisis. This is a U.S. dollar crisis and a sovereign debt crisis. That's a whole nother ballgame.
Yeah, well, I agree with Peter that the Fed wants inflation, but they don't know how to get it. And they haven't for the last 12 years.
Well, that's the one thing they do know how to do. They can cause inflation. That's all they can do. They can print money.
No, they can't. They can't, Peter. They printed $7 trillion in 12 years, and we got no inflation. Assets, yes, but I'm talking about.
I mean, prices are higher than they were 7 years ago, consumer prices, but we inflated a stock market bubble. We inflated a real estate bubble. We inflated a bond market bubble. I mean, asset prices went way up. We distorted the economy based on all that inflation. And look, consumer prices have risen, right? I mean, I don't care the way the government wants to keep track of them with their, with the CPI. The CPI is not an accurate reflection of what's actually happening with consumer prices.
It's pretty good. Look, if you want to count assets, you're right, but you're changing it's moving the goalpost. You're changing the definition.
No.
If you count assets, yes, but I count consumer prices or PCE core deflator, because that's how, if you want to predict Fed policy, that's what they look at. So you need to consider.
I don't care what the Fed looks at. I care about reality. And prices are going up, but that's not inflation. Because if the Fed didn't create all this inflation, maybe those prices would have really come down. Maybe consumers would have gotten the benefit of a lower cost of living. But the Fed stole that benefit away from them by creating inflation. But look, all of this inflation is going to come home to roost. All of a sudden, we're going to catch up and we're going to see dramatic increases in consumer prices. And then when you go back over the entire period, you can say, oh, look, prices are up 10% a year or whatever they're going to be, because all of a sudden they're going to shoot way up. And it's not going to matter that they were benign for a while when all of a sudden they skyrocket and catch up to where they should have been. But the cause was all the inflation the Federal Reserve has been creating the entire time.
Well, I agree that if the Fed didn't do what they did, we would have had more deflation. And in a way, they were just fighting it to a standstill. But we haven't had inflation for 12 years. Asset prices, yes, but that's not the definition of inflation.
The definition of inflation is an expansion of the supply of money. And that's what we've had in Spain. This is the greatest inflation that the world has ever experienced.
You can make up your own definitions, Peter. The definition of inflation is higher prices.
Jim, I'm not making up the definition. It's people today. You go back and get a Webster dictionary from 100 years ago, and you read what inflation is, and it'll say inflation is an expansion of the money supply of money and credit. Rising prices are an effect of inflation, right? Prices don't inflate. Prices go up and they go down. Money supply inflates. Inflate is to expand, right? You don't expand prices. What is being expanded is a supply of money. That's inflation. Inflation is an expansion of the money supply. Deflation is a contraction of the money supply. The effects of inflation and deflation are on prices. When you have inflation and you're inflating the money supply, prices will go up. And when you're deflating it, prices will go down. But sometimes you can inflate the money supply and prices don't go up because the inflation is preventing prices from going down. But don't confuse changes in prices with changes in money supply. Money supply is inflation. Prices are just prices.
The problem, Peter, look, we're talking past each other because we have two different definitions. If you say that prices are flat, but that's inflation, fine. That's not how any central banker in the world or any economist thinks about it.
The central bankers want to pretend that inflation has to do with prices because they don't want to be blamed for it. When you accept the real definition of inflation, which is an expansion of the money supply, then you know who causes it. It's government. It's central banks that cause inflation. But governments want to blame inflation on the private sector. That's why they want to redefine it as prices. And you're playing into their propaganda by trying to perpetuate the idea that inflation is caused by greedy businessmen raising their prices or labor or speculators.
Now you're way over the line because
you're saying inflation is prices going up.
You're putting words in my mouth that I never said. I said that inflation is measured by prices. That's just how you do it. If you have a different definition, that's fine.
Now, inflation is measured by the money supply. But the reason that you're not seeing a lot more money going into gold, especially the bigger institutional money, is yes, they do not yet perceive the threat. They think everything is fine. They believe Powell when he says inflation is transitory. So they're not as concerned. They just like they believe Powell or the other Fed chairs, Bernanke or Yellen, when they said, oh, QE is only temporary. Oh, we're going to shrink our balance sheet back down to pre-crisis levels. Oh, we're going to normalize interest rates. These were all lies that the Fed told, yet the markets believe the Fed. And now they're telling more lies, but the markets continue to believe every lie the Fed tells. And they don't look back at their track record and say, hey, these guys haven't really been honest in the past. Now, again, maybe it's not honest. Maybe they're just wrong. Maybe the Fed is just wrong in everything it says. If it's just wrong all the time, well, then why believe them now if their track record is they've always gotten it wrong? But I do think that at some point, more and more people are going to start to doubt the Fed. People are going to call the Fed's bluff. Like, okay, you can't do anything about all this inflation. And then gold's going to take off. So the opportunity now is that while most people don't perceive the threat and are just acting as if everything is fine and investing as if inflation isn't a concern, that's why gold is a bargain, and silver too, for that matter, for all the people that do understand where this is headed and can think ahead of the curve. We're not getting all this stimulus for free. It's going to cost a lot of money. This next round is going to be accompanied by some official tax increases. How much they'll actually raise is always hard to say. They never raise as much as they think, and they always spend more than they think. So I think the tax increases will only provide the government with a relatively small portion of what they're going to be spending on these new programs. And so they're going to mainly rely on inflation, right? The Fed is going to print the money to buy the bonds that the government issues to fund all these programs. And, the dollar is going to crash and prices are going to soar. And, people need to be prepared.